please. Okay. And 2 or 3 weeks later, I will let you know your midterm exam performance as well as the homework and the quiz score. A little bit short time. So yeah, one of the so the I already let you know. So right, so time I told you you need to hurry up. Right, the time is not enough to finish up the midterm exam. Okay, so time is another the problems, right, to finish up your the midterm exam. Okay, so anyway, the contents that we will cover in the second half of this course is the more tough. So you need to read very carefully, and you need to pay attention to what I will talk about. Okay. All right. So today we will talk about the stock and their valuation, which is chapter 10. So according to the textbook, chapter 9 is bond, chapter 10 is stock. But I think you are familiar with the stock more than bond. So we will talk about the stock first, and then we will go back to the chapter 9, which is the bond. Right? So you know, there are two main resources to raise a fund from the point of the company, right? So the company may issue the stock, okay, or may issue the bond. So the same originality, but the name is stock or bond. But from the point of company, we would say company issue the stock to raise a equity. Right? The company issued the bond to raise the resulting in the debt. Okay, so from the point of the company, that is called as equity, that's called as debt. But from the point of the investor, it's gonna be stock, it's gonna be bond. So the original characteristics is same thing in the stock or equity, but the terminology is different depending on we need to think about that thing from the point of the investor or company. Okay, so don't be confused of the terminology. So equity is stock, debt is the bond from the point of the company, from the point of the investor. Okay, so company may issue the stock or may issue the bond. Okay, so first of all, we need to figure out, talk about the stock first. So in chapter 10, we will talk about the basic features of the stock first. And then we need to estimate the intrinsic value. So we already talked about that issue in chapter 1. So if you have the textbook, page number 11, figure 1.2, we already covered the topic, the determinants of intrinsic value and stock price in figure 1.2 in page number 11. But the same figure, figure 1.2, appears in the chapter 10 as well. Again, in figure 10.1, page number 368. So figure 1.2 is same figure of the 10.1 in page number 368. So if you take a look at the page number 368, I already explained, stock price has been always changed, right? So some event occur, so event including managerial action or economic environment change, we already covered this issue, and political climate change. Okay, so some event occurs, then we can think about two dimensions. One dimension is what? Intrinsic value, through return, through cash flow is changes, through risk is changes after some event in the company, right? The two dimension. Another dimension is the what? Investor perceive cash flow change. Investors perceive risk is change. Okay, even if the same event occurs, but we can think about two dimensions. One of the dimensions is from the point of the true cash flow, true risk, and the other dimension is perceived. Investor perceive the cash flow, investor perceive the risk. So based on true cash flow, true risk, intrinsic value is changed, right? Based on perceived cash flow, perceived risk, market price is changed or stock price. Okay, so intrinsic value is not equal to market price in general time, right? Generally, right? Generally. But in equilibrium, I already explained this one. In equilibrium, intrinsic value equal to market price. Then what is equilibrium? We figured out equilibrium in finance two ways. First one is what? Supply balance demand. Supply balance demand. That's the first requirement of equilibrium. Second requirement of equilibrium is no opportunity to arbitrage opportunity. Arbitrage opportunity, right? No arbitrage opportunity. So we figured out two requirements to satisfy equilibrium. So if this kind of equilibrium condition is satisfied, then intrinsic value is equal to market price. Otherwise, intrinsic value has the distance, is the deviate from the market price. Okay. So second topic of this chapter, first topic is that this chapter is we need to figure out the features, basic features of the stock. Second topic is we will try to calculate this intrinsic value. Okay, so if our calculated intrinsic value is higher than market price, then what? That stock is undervalued, right? Undervalued. But if intrinsic value is lower than market price, then that kind of stock is overvalued, right? So definitely undervalued stock, we need to buy, we need to sell or short sell the overvalued stock. Okay, so the reason why we figured out the intrinsic value is what? Whether or not we buy or sell the stock comparing to the market price. Okay, so the second topic of this chapter is to figure out the intrinsic value. All right. Okay. So in this chapter, let's take a look at the overview. What kind of thing we need to cover on this chapter is the basic features of common stock. We need to figure out the basic features of common stock first. And then we need to try to figure out the intrinsic value of the stock by using this kind of methodology. First one is dividend discount model, discounted dividend model. So we estimate the cash flow, we estimate the intrinsic value of the company by using dividend, only dividend. And second method is corporate valuation model, corporate valuation model. But most of textbook provide a lot of the pages to explain the dividend discount model. But in reality, dividend discount model is not used. As much as we study in the textbook. Why? We will talk about the reason why. And the corporate valuation model is more complicated than dividend discount model, but in reality, the corporate valuation model is widely used rather than dividend discount model. So these two models are basic, very basic models to calculate the intrinsic value. So other than these two basic models, we have tons of models, just like the asset pricing model, right? So in asset pricing, in terms of asset pricing models, I told you there are tons of asset pricing model, but we only figured out the capital asset pricing model, right? The very basic, fundamental model to figure out the relationship between required return and systemic risk, right? But other than CAPM, there are a lot of the asset pricing model, but those kind of things are complicated to cover in the financial management level. So just like the CAPM, the two models are very, very basic model to estimate the intrinsic value, but at this the financial management level, we only cover these two models. Other than this model, we have lots of things. So if you're interested in the this stock valuation, then you can take investment class taught by me. Okay, so a more advanced course. So the in investment class, I will explain. I will introduce the several other as uh, the stock valuation models. Okay, preferred stock is another type of the stock. Stock has two types, right? Common stock and preferred stock. There's only two the type of the stocks, common stock and preferred stock. Only difference between common stock and preferred stock is what? Whether or not we have voting right, right? Voting right. So voting right is the most fundamental, most important right of shareholders. Okay. So in common stock has the voting right, whereas preferred stock doesn't have any. Preferred stockholders doesn't have do not have any voting right. Okay. All right. Let's take a look at the basic features of common stock first. Common stock. So the stock, the fact that you have one share of Samsung Electronics, for example, Junse, not Junse E, but Junse Kim. Junse, if Junse has the one share of Samsung Electronics, for instance, then Junse is the owner of Samsung Electronics, just like Gon-hee Lee, Jae-yong Lee. Yeah, so we'll say the owner, right? But how much owner? Point 1% owner, right? Of the Samsung Electronics, but still owner, right? 1% owner, right? So the fact that we have the stock or share, one share, of the stock means we have ownership of the company. Okay, ownership means the control of the company. If you have the ownership, then you can have the right to control the company. All right. So, and in terms of control, there are three kinds of terminology here. Each one is very important thing. So let's take a look at the one by one. So I told you ownership implies control, but there are three kind of things to exercise or keep our control, right? Okay, the first one is proxy fight. Proxy fight, to understand the proxy fight, you need to understand the annual general meeting first. 주주총회 in Korean. Annual general meeting. 주주총회 in Korean. Annual general meeting. So annual general meeting of shareholders is where shareholders can exercise their voting right to make certain decision, very important decision related to the company, right? So there are some agenda to list it up on in the annual general meeting, right? So agenda to make decision, right? So it's a very important agenda. So agenda include the approval of financial statement or approval or dividend, just like that. But other than this one, approved thing one, more important thing is what? Make appointment of the member of board of director. That is the most important role in annual general meeting. Member, so we can select or appointment members and board of director, right? So as you know, board of director can make the decision, all of the important decision related to the company. So the work to select the member of board of director is so important thing. Okay, so the most important agenda in annual general meeting is to select, appoint the member of board of director. Okay, but generally there are some conflict amongst the shareholders, right? So some shareholders want to select, some A shareholders want to Z, want to select the Z, member Z, as the member of board of director. But owner B want to select the Y as the member of board of director, right? So each entity has for example, just like this kind of the things, then we need to vote, right? Vote who we need to select, right? So we need to exercise voting right in this case. Definitely, who is gonna be win? The entity who has more 또 이러네. connections 또 이러네. More ownership. Okay. So for example, A has 30% of ownership. B is only 1% of ownership. Then definitely Z is gonna be the member of board of directors. Z can be selected as the member of board of directors, right? Then what should B do? It has only 1% of the ownership. Then B can solicit voting right from other shareholders. Give me the voting right. Give me the voting right. So the solicit the voting right to the B from other the shareholders. That is called as proxy. Proxy. So page number 365. There's some definition of proxy. Proxy is a document giving one person the authority to act for another, typically the power to vote share of stock, common stock. Okay, so stockholders can appear at the annual meeting and vote in person, but typically they transfer their right to vote to another person by means of proxy. Okay, so Junso has one share of Samsung Electronics stock, but Junso has only 0.00001% of ownership. But then, even if Junso is participated in the annual meeting in Samsung Electronics, but it's useless, right? We do not do anything. We cannot do anything with only 0.00001%, right? So we can collect all of the small number of shares. Okay, we can do that, right? So we can transfer our voting right to another party. It's called as proxy. So in this case, so if B now collect the 30% of voting right from other the small ownership or small stockholders, then we have now fight. This is called as a proxy fight. Okay, so proxy fight is an attempt by a person or group to gain control of the firm by getting its stockholders to grant that person or group the authority to vote its shares to replace the current management. Just for example, okay? So if Junso has one share of the stock, then usually Junso doesn't go to the annual meeting, general meeting. So instead of the participating the general meeting directly, the Junso can transfer his voting right to another party, right? Who has some the fight with major the stockholders. That is called as proxy fight. So even if my ownership is very putty, right, very small, pretty small, but I can exercise my voting right to the some entity more than, the higher than my ownership, the ownership the rate. Okay, that's the proxy fight. That's the first methodology to keep the control of the company. That's the proxy fight. And second way is the preemptive right. Preemptive right. Preemptive right is just like that. Preemptive right is the existing ownership is the, for example, A has the 30% ownership of company Z. B has a 20% ownership of company Z. C has 10% of ownership of company Z. Then, what if company Z now issue the stock again? That's the SEO. It's called as SEO, seasoned equity offering, as I told you. Seasoned equity offering, 증자 in Korean. So if the company want to have the more money, need more money, then the company can issue the additional stock to the public. That is called a seasoned equity offering. Okay. Then the company issue the seasoned equity offering before go to the public. They should provide the new stocks based on pro rata basis to the existing shareholders. Okay, so for example, the capital is 100, for example, then the Z company issued 10 more. Then A, the company Z should provide 3 to A, 2 to B, 1 to C. Otherwise, ownership rate is gonna be changed, right? So if the company do not provide the right to buy to the existing shareholders on pro rata basis, then each existing shareholders has the different, the ownership is gonna be changed. Ownership rate is gonna be changed, right? This is called as preemptive right. Okay. So 신주 우선 배정권 in Korean, 신주 우선 배정권 Korean. So the preemptive right is defined as the page number 366, just like a provision in the corporate charter or bylaws that gives the common stockholders the right to purchase on a pro rata basis new issues of common stock. Okay, so if the company issued a new stock or new convertible bond, issue stock or convertible bond, then company should give some the stock or convertible bond to the existing shareholders on pro rata basis. This is pro rata basis, right? Pro rata basis means the current ownership rate, right? Current ownership rate. To keep the ownership rate, the company should give the right to purchase the new stock or convertible bond to the existing shareholders on pro rata basis. That is called as preemptive right. Otherwise, the ownership rate is gonna be changed if the company issued a new stock or convertible bond. In this sentence, the convertible bond is also important thing. So I already explained the convertible bond, what convertible bond is in chapter 2, financial market and instrument. When we talk about the financial instrument, I already let you know the convertible bond briefly. So convertible bond is the current characteristic of the securities bond. Okay, but this bond is gonna be converted to the stock, right? So finally, this instrument, this security is going to be stock from the bond. Okay, so stock that affect the ownership, the rate, right? Ownership rate. So as well as the convertible bond and the stock. So the company issued the stock or convertible bond, then the company should provide a preemptive right to the existing shareholders. Okay, that's the second way to control the company. All right. And third way, another way is the classified stock. Classified stock. Classified stock means one share, it is not necessarily one share as one voting right. It is not necessarily. Okay, so some classified stock has 10 voting right, more than one voting right. Okay, so it's not necessarily all share has the identical voting right. Right? So some stock. So the company issued the common stock with some different type. So classified by some type. Right? So here's a very good example here. So Google went to the IPO for the first time in 2004. In 2004, offering price at the time is about $100, $100.1 or something like that. Google. Now, current Google, what is the how much is the this is Alphabet now, right? The company name is the Alphabet, the holding company. What is the stock price of Alphabet as of today, as of yesterday? How much is that? Any anyone who knows? This Google stock was $100, about $100 in 2004. Okay, 2011, 2012. This $100 now, how much is that? 몰라? Google, Alphabet. Here you go. 우와, 우와, $2,848. It's about 30 times multiples, right? 30 times. $100 in 2004. What did I do? In 2004, if I buy the 10 number of shares, then wow, it's gonna be rich now, right? What did I do? 30 times up for the last 17 years. Wow. In 2004, I still taught you, right? So in that class, I explained the Google. Wow, what should I do? Wow, what did I do? I was going to buy the shares, then I don't have to teach you this, right? Okay. Anyway, yeah. So this is so why is the Google? Why I'm explaining Google? So according to the textbook, in when the Google went to the IPO, there are two kinds of the stock type, Class A and Class B in textbook. Okay, so Class A, for example, when Google went IPO public, it sold Class A stock to the public, and stock where while its Class B stock was retained by company's insider. So to insider, the Google give the Class B stock. The key difference in the Class B stock has 10 voting right. Class A is just one voting right, the same as the stock. Okay. So even if the number of stock is same thing in Class A and Class B, but the voting right is 10 times in Class B. right? So the Google's Class B share are predominantly held by the company's two founders and its current CEO. Okay, so it's not necessarily that the one share has the one voting right. Right? Some share has the more than one voting right, which is called as classified stock. So the classified stock is defined as common stock that is given a special designation such as Class A or Class B to meet special need of the company. Okay, so to keep their ownership, when Google went to the IPO, Google has the two types of the stock. There is another way to control the company. Okay, so we covered the classified, preemptive right, and the classified stock to control the ownership. Okay, so as I told you, stockholders elect the directors, members, board of directors, and directors select the executive manager, CEO. Or sometimes in annual general meeting, we approve the new CEO or the elected by directors. Okay, so the annual meeting is so important for the stockholders, especially to select elect the member in board of director or approval of the new selected CEO. Okay, or sometimes we in the annual meeting we can change the article by article of the company. Company's article charter, the charter 정관 in Korean. Okay, that's the basic features of the stock. Okay, and let's go to the second topic, the intrinsic value and stock price. As I explained, the outside investors, corporate insiders, and analysts use a variety of approaches to estimate a stock's intrinsic value, P0 intrinsic value. So equilibrium condition means the situation that the supply balances the demand, or there's no opportunity, there's no arbitrage opportunity. That situation is called as defined as equilibrium in finance, especially. So in equilibrium, we assume that a stock's price equals its intrinsic value. Otherwise, the intrinsic stock price has the deviation from the intrinsic value. Investors, as I told you, the amount of the perceived by investor is the different, right? In terms of the return and the risk of the perceived amount by the investor is the the difference of those of things in the true return or true risk. So there's a gap between the intrinsic value and the market price. So outsiders estimate the intrinsic value to help determine which stocks are attractive to buy and or sell. So attractive stock means what? Undervalued stock, right? So the stock with the price below its intrinsic value are undervalued. The stock price is above in intrinsic value is the overvalued. So market price is below the intrinsic value, then it's gonna be below the intrinsic value is the undervalued. The market price is higher than the intrinsic value. This is overvalued, right? So undervalued stock should be bought. Overvalued stock should be sold. Okay. So the reason why we try to estimate the intrinsic value is because we need to make decision whether we buy or sell the stock comparing to the market price. Okay. So there are two kinds of the models estimating the intrinsic value. There are two ways, two methodology to estimate the intrinsic value of common stock. First one is dividend discount model or discounted dividend model. Dividend discount model, or we would say discounted dividend model. Second one is corporate valuation model. Here is question. So as I told you, most of the textbook explained a lot of the things for the dividend discount model rather than corporate valuation model. But in reality, we do not use the dividend discount model in a popular way. Why? Why is that? Why we do not use dividend discount model in reality? Why is that? 혜진.
Yes, Professor.
Why? What I'm asking is the most of the textbook allow a lot of the pages to explain the dividend discount model, but this is the we would say the useless in the sometimes useless in the reality in real the estimation. So the why?
I don't know. I'm sorry.
You don't know me. You don't know me. Okay. All right. Then 정호. Talk about it. Why? The reason why. Complexity. So just like complexity. But as I told you, dividend discount model is the simplest way to estimate the intrinsic value. I cannot hear you. So this was disconnected. Yeah. Say again, please. So because the dividend discount model is so simple, so we cannot use this model in the reality. So which means the cannot reflect all of the factors to affect the intrinsic value, right? He said just like that, but a little bit the distance from the correct answer. Okay, right, Donghwan. More fundamental issue, more fundamental reason why we do not use dividend discount model frequently. Donghwan.
Yes, Professor. Mm, because we can't expect to future.
We can expect a future dividend. Yeah, that's
Yes.
one of the reason. But as you shall see, all of the model to estimate the intrinsic value, we need to anticipate, expect, we need to forecast some the value in future values. So that is very good answer, but that answer can be applied to another model as well. Okay, so that reason is can be applied to all of the models. Okay, so yeah, not bad, right? Okay, Mark, what do you think about it? Why
Yeah,
we do not use the dividend discount model frequently?
I don't have any clue. I don't have anything else to add.
All right, okay. How about the Paul?
I saw this model, but I
You stopped?
didn't remember anything on it.
Okay. If I ask something, then within the five called the student, the most of the cases, within the five student, give the correct answer. So 하나, 1, 2, 3, 4, 5. Okay, Virginia, please. You are the sixth guy. Yeah. What's the answer?
Yeah, I knew my turn was gonna come, but yeah, I don't know. I also don't know. I'm sorry.
Alright, okay. 6번 갔어. 그럼 7번째야. Please help me. 준서.
I think it is because we have to consider the fact that not all companies give out dividends.
Exactly. You are right. Thank you. Exactly. 준서 is right. Yeah. So it's not necessarily all of the company provide a dividend. Okay. So for instance, here in Korea, about 50% of the listed company provide a dividend. Okay, then how can we estimate the intrinsic value of the company do not provide a dividend? In this case, another 50%, we cannot use the dividend discount model because there is no dividend. Then how can we estimate the intrinsic value by using dividend? All right, that's the most fundamental reason cannot use the dividend discount model. Thank you, 준서. 역시 준서 is the brilliant, right? 준서 is very brilliant. Yeah. 준서, 준서, Kim. Yeah, right. Okay, so that's the fundamental reason. So in reality, corporate valuation model is widely used than the dividend discount model. But most of the textbook provide lots of pages to explain the dividend discount model because it's very easy to understand. Okay, so let's take a look at the dividend. How can we estimate the intrinsic value by using dividend discount model? The dividend discount model, discounted dividend model is a model of the stock is the present value of future dividends expected to generate by the stock. So from the point of the cash flow, now let's take a look at the cash flow perspective. Then cash flow perspective. Okay, so because Junso got the answer, so Junso has the one share of Samsung Electronics, for example. Okay, then from the point of the Junso, what kind of the cash flow we can expect? For example, Junso make decision to hold. It's very weird. I'm repeating my name. Okay, very weird. Right? Okay, the Junso make decision to hold the Samsung Electronics share just for 1 year, okay, and then want to sell the Samsung Electronics stock, okay. Then from the point of the Junso, the cash flow that Junso expect is what? Dividend that I will receive 1 year later, plus what? Stock price that I sell 1 year later. Okay, that's the total cash flow from the point of Junso. Okay, if Junso hold this stock 1 year, then that's it, right? D1 plus P1. D1 plus P1 should be discounted by what? 1 plus RS to get the present value, right? Present value. So we already figured out the time value of money, right? So the value that, the receive at 1 year later of dividend and the stock price not equal to when I receive the dividend and the price when as of today, right? There's a different value, so we need to discount by 1 plus RS. In this equation, RS is the, already RS. We already figured out RS, what? Required return from the point of investor. From the point of the company, this is the cost of equity. As you shall see later on, cost of equity means the cost. Now, from the point of the company, this is what? Cost to raise the equity, to raise a stock, which is the same as what? The return that the investor ask, right? The required rate of return. So by the same token, the RS can be expressed by required rate of return, or cost of equity from the point of the company, from the point of the investor. RS is a required rate of return. So RS can be calculated by RF plus RM minus RF times beta. We are familiar with this equation. This is a CAPM, right? SML, right? So by using CAPM, we can figure out the RS. So this is the intrinsic. This is the value of the stock. So value of the stock is expressed by P hat or V hat, for example. Okay. So if Junso has the hold this stock for 1 year, then the cash flow to the Junso is just like that one. Okay. But Junso now changed his mind. Oh, Samsung electronic stock is good. Then I want to keep 1 more year. Okay. Then the cash flow that the Junso can receive is what? P1 divided by 1 plus RS plus P2 plus P2 divided by 1 plus RS square. Okay, if the Junso hold this stock for 2 years, but the Junso now think about again, to hold 3 years is better than hold 2 years. Then the cash flow stream that the Junso receive is the 3 term, right? P1 divided by 1 plus RS, P2 plus P2 plus 1 plus RS square plus P3 plus P3 by 1 plus R to the power of 3. If Junso hold 3 years, this stock for the 3 years, then the value or price is gonna be just like that. But the Junso, now make decision, final decision. I think the Samsung electronic stock is the best all of the world. Right? So I make a decision to hold this stock forever. Okay, forever. Then cash flow that Junso receive is the dividend that I will receive the 1 year later, dividend that I will receive the 2 years later, dividend is 3 years later, 4 years later, 5 years later, infinity, right? 1 plus R S infinity. The reason why I didn't write down P infinity plus RS infinity, the same thing. It's almost 0, right? So if we have the infinity as exponent, then that term is gonna be 0. So this is also 0. But the reason, I mean, because we write down the d, so I expressed just like d, right? So d infinity plus p infinity is same as d infinity, right? So the reason why there's that thing, okay? That is dividend discount model, okay? That is dividend discount model, right? So discounted dividend model, the value of stock is present value of the future dividend expected to be generated by the stock, future dividend, right? So to calculate the intrinsic value by using dividend discount model, we can estimate the dividend that I will receive the next year, 2 years later, 3 years later, 4 years later, 5 years later, 7 years later, 10 years later, 100 years later, 1,000 years later. How come? It's almost impossible, right? So we need to simplify the assumptions. How come? Now we can assume that what? The stock whose dividends are expected to grow forever at a constant rate. Okay, so dividend is, the growth, but the growth rate is constant as G, right? So dividend grow at a constant rate as G, okay? Then D1 can be expressed by D0 times 1 plus G, because we assume that the dividend grow at a constant rate. And D2 can be expressed by D1 times 1 plus G, right? Comparing to the D2 with D1, D2 increase as much as 1 plus G multiplication, right? So D1 times 1 plus G can be expressed by D0 times 1 plus G squared, because D1 is the D0 times 1 plus G. So if we substitute this equation, then D2 can be expressed by D0 times 1 plus G squared. So if we repeat this procedure, dP can be expressed by D0 times 1 plus GT, okay? So if growth rate is constant, then the dividend growth formula converges to just like D1 divided by RS minus G. D0 times 1 plus G divided by R minus G. How can we this equation? Let's derive. Okay. So price is D0 times 1 plus G 1 plus RS plus P. This is T1, right? This is T2. T2 is expressed by T1 1 plus G equal to D0 1 plus G squared, right? Divided by 1 plus RS squared plus T3 1 plus RS to the power of 3. T3 can be expressed by T2 times 1 plus G is expressed by T1 times 1 plus G squared expressed by D0 times 1 plus G to the power of 3, right? Forever. Okay. Then, what's that? In the past, we already talked about this one. This is what? Sum of infinity geometric series, right? 무한 등비 급수의 합. Sum of infinity geometric series. 무한 등비 급수의 합 in Korean. By definition, 원등비급수의 합, sum of infinity geometric series is the A divided by 1 minus R, right? I already explained that one. A is the initial term. This is the initial term. R is the common ratio. Common ratio. So common ratio, what's the common ratio? As I explained before, common ratio is some terminology from the first term to reach the second term, right? So if we first term times something, then that's gonna be second term, right? So, and if we second term times something, it's gonna be third term. If we third term times something, it's gonna be fourth term, right? This something is called as common ratio. Okay, so in this equation, what's the first term? First term is D1 divided by 1 plus RS, right? First term is first term, right? First term. D1 divided by 1 plus RS, or D0 times 1 plus G divided by 1 plus RS is first term. What is the common ratio? How can you get the second term from the first term? 1 plus, numerator is 1 plus G. Denominator is 1 plus RS, right? So T1 divided by 1 plus RS times 1 plus G divided by 1 plus RS is going to be second term. Okay, so second term, T2 divided by 1 plus RS squared times 1 plus G divided by 1 plus RS is going to be third term. Okay, so the common ratio is 1 plus G divided by 1 plus RS. If we rearrange this equation, then 1 plus RS minus 1 minus G divided by 1 plus RS. 1 plus RS wiped out. So remaining one is D1 divided by RS minus G. That's it. So if we assume that dividend grow at a constant rate, then we can figure out very basic, very simple equation to calculate the intrinsic value, right? That's the dividend discount model or golden model. So especially if golden is the name of the human being. So if the dividend grow at a constant rate, then the intrinsic value can be calculated by using those kind of very simple equation. Okay, that is called as golden model. Then this golden model has also the limitation. See, the most the flaw, the crucial flaw is just like that. What if RS is lower than G? In other words, if the cost of equity or required rate of return is lower than dividend growth rate, what happened? The denominator is going to be negative. Then stock price is negative. It's weird, right? Ridiculous. Okay, that's the very crucial flaw to use the constant growth model. Okay, so to use the constant growth model, RS should be higher than G. Okay, otherwise the result is gonna be very ridiculous. So if G is higher than the RS, the constant growth formula return negative stock price, which does not make sense. Okay, so first one is what? RS should be higher than G. Okay, so another limitation is what? How the dividend grow at a constant rate? It's impossible, right? So I cannot see any company whose dividend grow at a constant rate. Okay, so that's very ridiculous assumption, but to understand how can we estimate the intrinsic value at this financial management level, we just think about that one. So the RS should be higher than G to use the golden model. Okay. Then now to use the dividend constant dividend discount model, then we figure out D1 divided by RS minus G, right? So D1 we can anticipate or we can expect the D1, okay? And the RS, how can we calculate the RS? I already let you know by using CAPM, right? So we can figure out the RS. Then how can we figure out G, growth rate? How can we calculate the growth rate? Growth in dividends occurs primarily as a result of growth in earning per share, EPS. Factors affecting growth rate of dividend is the amount of earnings. This is the size of earnings the company retains and reinvests. This is called as B, retention ratio or plowback ratio. Retention ratio or plowback ratio. And ROE is return on equity. Return on equity is the, we can, the main determinant of earnings is the ROE, return on equity, right? Return on equity. So we also consider the inflation. So G can be calculated by ROE times plowback ratio. Plowback ratio. So now we are figuring out how can we calculate the G. Okay. This is the earnings, right? This is the earning. So the main reason to exist the company is what? To generate the earnings or profit. Okay, profit. Then if the company generate earnings, then some part of earnings should be paid out to the shareholders. This is called as dividend. Right? And some part of earnings can be retained within the company to reinvest, right? As resources to reinvest it. Okay. So dividend growth rate can be calculated by ROE times B. So this ratio is called as plowback ratio. Retention ratio or plowback ratio, and is expressed by B. Okay. So for example, if the company generates the 10 of the earnings and 6 out of 10 is retained, then a plowback ratio is the 60%. Okay. So it's the common, right? So to increase the dividend, basically we need to retain more money, right? We need to retain the more earnings to, reinvest something. So to increase the dividend growth rate in next period, basically we should retain more money, and then we can reinvest that money, then we can generate the more earnings. Okay, so growth rate can be calculated by the positively related to the B. And another thing is, another factor is what? ROE can make the size of this earnings, right? Size of this earnings, size of this earning. Return on equity. ROE is a return on equity. So out of equity, how much we can generate the return, earning, profit in the some specific period, okay? So ROE can determine the size of this pie, and B is the, the potential growth to the dividend in the next period, because this is the represented by the, how much we can retain, not pay the cash to the outside, but how much money we can retain within the company, right? This is flowback ratio, retention ratio. So growth rate can be calculated by ROE, and standing for the pie of earnings, and times B, ROE times B. Okay. And what is called this ratio is the portion to of the earnings to the shareholders as dividend. This ratio is dividend payout ratio. Dividend payout ratio. So dividend payout ratio plus flowback ratio is gonna be 뭐가 돼야 돼? Dividend payout ratio plus flowback ratio is gonna be 1, right? It's gonna be 1. Now let's see again. Flowback ratio plus dividend payout ratio is gonna be 1. Okay. So the portion of profit to paid out to the shareholders as dividend, this is called as dividend payout ratio. So dividend payout ratio can be calculated by dividend per share divided by earning per share. It's out of earning per share, how much money we can receive as dividend. That's the dividend payout ratio. So dividend payout ratio plus flowback ratio is gonna be 1. And the last thing is that don't be confused of the dividend payout ratio and dividend yield. Dividend yield is the dividend per share divided by current stock price. So which means what is yield is the return, right? Return. What is the profit? Return. What is the return of the in terms of the dividend? So one of the, the stock investment strategy to the stock is what? We can pursue some stock that provide the dividend more. Okay? So 배당주라고 그러죠? 배당주, dividend stock. So some stock provide lots of the, so some stock provide high dividend payout ratio. Okay? So one of the investment strategy in the stock is we can pursue some stock that provide lots of the dividend, the higher dividend payout ratio. So some stocks dividend yield is higher than the 5%, which means what? It's better than some the savings rate or the bond rate, interest rate, right? So there are some stocks that provide higher than 5% of dividend yield. So there is another stock investment strategy. So anyway, dividend yield can be calculated by dividend per share divided by current stock price. So don't be confused of dividend yield with dividend payout ratio. All right. Mr. Pierre, any question? as I told you, when we start this class, it's getting complicated, more complicated. So just please read the textbook or at least the PowerPoint to prepare the class in advance. Right? Any question? Nope. Okay, then bye. See you next week.